Everybody, this is Pete Nelson, Vice President of Sales with PlanetTogether. I want to welcome you to our webinar today. And before we get started, I just wanted to kick things off by introducing Jim Serra, our President and CEO, to say a few words.
Thanks, Pete. Welcome, everyone. Thank you for investing an hour of your time to be with us today. At PlanetTogether, we think that manufacturers like yourselves are everyday heroes. Maybe you make food that people eat, clothes that people wear, tools that help people work, medicines that cure illness, or products that just make life more fun. Whatever you make, our job is to help you make more product, make more profit, and make your work easier. Scott McMartin is the keynote speaker today. Scott has over 20 years of experience in manufacturing sales, marketing, and supply chain management. His goal in the next hour is to provide you with one new effective idea for increasing profitability that you yourself can take action on immediately. Scott, it's all yours. You can take it away there.
Thank you, Jim. Hello, everyone. On behalf of PlanetTogether team and my presentation partner, Pete Nelson, who you heard from initially, I want to thank you for investing your valuable time in today's event. As Jim said, our objective is to provide you with a new insight that will be immediately useful to you in supporting your company's pursuit of its business goals. Essentially give you a chance to be a hero in these challenging times. Before I get started, though, Pete, is there any housekeeping issues that we'd like the attendees to know about so that they can submit questions if needed?
Yes, thanks, Scott. Just a little thing to get out of the way. We're definitely hoping to have some time towards the end of the presentation to address some questions that might come up. So we definitely want you to all to feel free to use the question box or the chat box that you should see in your go-to webinar control panel. So feel free to type those in as they come to your mind. We'll do our very best at the end to go ahead and address those questions. And of course, if we don't have time to get to everybody's questions, we'll do our very best to follow up with you a bit later on. So looking forward to a very informative and educational session, and that's the only housekeeping that I've got.
Great. Okay. Well, thanks again, everyone. As you know, the topic for today is the use of the measurement throughput velocity and how that can be used very, very quickly by you and your companies to essentially ascend to a market leadership position within your target market. To that end, here are the milestone objectives we have for this session. First, we'd like to take to lay the foundation for what is or should be the goal for our businesses. Next, we will take a look at some traditional organizational measures with which we are all familiar and see how they affect our decision-making in pursuit of the goal. Then, we will try challenging the conventional wisdom, asking, is it possible that systems and philosophies designed and implemented immediately after World War II, when the U.S. had the only viable industrial economy, but are still the foundation of our present-day financial and operational infrastructure, could be misaligned with current global market reality? If so, might it be reasonable to take a look at today's challenges from a different perspective? Finally, assuming today's presentation creates both some degree of anxiety about current strategies as well as excitement about new ones, we will provide some initial steps, assign some homework, if you will, to help you validate these concepts and begin to put them to use. Underpinning the strategies of today's session are two guiding principles. The first is that every business entity has the same singular purpose if it expects to be viable over the long term. That is, to attract, retain, and grow customers at a profit. Key here is the meaning of the word profit, specifically regarding its definition in a manufacturing environment and degree. The second maxim dictates that in order for a business entity to ensure its viability, it must create economic value. That is, it must earn net operating profits greater than its weighted average cost of invested capital. Otherwise, given the inherent risk, one would be better off simply investing in a mutual fund. Before we move on, take a minute to think about your firm's current ability to create value. Take your current capital base investment and multiply it by 7%. The historical weighted average cost of capital has been 12% plus a risk factor or a beta, but for our purposes in today's economy, 7% would be reasonable. If this number is greater than your firm's current net operating profit after tax, even if net operating profit after tax itself is positive, the firm is technically destroying value. An example of that would be if you have a $40 million capital base and you multiply that by the 7% weighted average cost of capital, you'd have a capital cost of $2.8 million. It makes sense to me that the business plan then should actually be oriented around generating profit in excess of that number. So if your NOPAT or net operating profit after tax is $2 million, which many companies would be celebrating over, in fact, you're technically destroying the value of the firm. So given we accept these two principles, we agree that a business must earn a profit by serving customers, and it must earn profits greater than its cost of invested capital to create value.
And so, Scott, a question that came into my mind as we started, talking and preparing for today was, for most of our customers that we work with, just trying to be profitable can be a struggle in itself. So, could you explain a little bit more about this cost of capital concept and how that really affects, a company's viability in the long term?
Mm-hmm. Yeah, over the years I have come to realize that in order for a business to truly create economic value, the level of profit generation has to be enough to cover the cost of invested capital being used to create the profits. Essentially, a firm has to accept that it has a responsibility to earn a return that includes a risk premium. Otherwise, there are much safer ways to invest. Capital flows to the opportunities with the greatest returns. In today's especially tough lending climate, it is absolutely critical that a firm earns its weighted average cost of capital. Historically, since the Great Depression, that capital cost has been around 12%, with some firms like Raytheon only 10 years ago assigning capital costs of more than 16%. So I guess, the issue here is just being profitable isn't enough. You have to be profitable enough to justify actually being in business as a manufacturer. So this is just a way of sort of, helping people to understand that, there is a specific goal here from a profitability point of view that we really have to keep in mind. And I'll tell you what, I've been in companies where I've been the VP of sales and marketing, and when we were constructing the business plans, initially our CFOs were not even thinking about this. They were basically trying to come up with a profit number they thought they could reach, but never did they think that there was an obligation on the part of the management team to actually earn profits that were greater than the cost of the capital entrusted to us by the stakeholders, whether we be a public company or private. Does that help at all?
Yeah, Scott, I think that's really helpful. And for someone like myself who's definitely not a financial wizard, there's a lot to think about here. But I think the basic concept is that being able to talk about what truly matters to the business, that it may not just be profitability, but really diving into the details can be very important. And so for everyone who's participating today, being able to ask those kinds of questions along the way will be helpful too. And there's going to be a lot of great material, and we're looking forward to following up with you all in more detail if that's appropriate down the road. So thanks very much, Scott, for that.
Okay, great. Well, hopefully that was helpful. We've got about 30 minutes of content here, so there'll be plenty of time to address questions either in flow or at the end. So, Pete, you help us make a decision on, when it might be best to address one of the attendees' questions if they submit them.
Will do.
So, just what's so hard about generating a value-creating profit as a manufacturer? We buy material, we add value. And by adding value, I mean we do business on the basis of either price, service, or technology leadership. We're either the Walmart, the Nordstrom, or the Versace of our industry. And then we sell the product based on that value to our excited and eagerly awaiting customer. It is the case that the Walmart value proposition does not appeal to the Nordstrom customer and vice versa. So it's very critical in this area of value proposition. That's what manufacturers do. They actually convert a material into a finished product, and they do it for a specific target market. So it's very critical that we keep that in mind, because that does have some impact on how we make capital investment that we're going to try to earn our cost of capital on. First of all, in even the simplest of supply chains, our internal supply chain, we are challenged by interesting dynamics of dependency and variability. But because we are buying from suppliers and selling to customers, we have yet another level of complexity addressing the external supply chain. This is especially true if we are the 50-pound chimpanzee sitting between two 800-pound gorillas. both of whom will try to dictate the terms of our relationship. I can't tell you how many companies I've walked into where the joy of receiving their first order from Walmart was quickly replaced by the agony of actually having to serve Walmart in a profitable fashion. It's not to say that doing business with Walmart is a bad thing. It's just that you have to understand there are assumptions that they're making about your ability to serve them, and customer is always right. So you always got to keep that in mind. Further complicating the achievement of value-creating profitability within a complex supply chain, though, is the fact that even present-day business systems still assume we have unlimited capacity and material availability. Now, sprinkle a little conflict in the form of often competing performance measures, pitting internal efficiency against market effectiveness, driven by an entrenched financial framework known as cost accounting, further bolstered by GAAP accounting standards. As you will soon see, it is almost a miracle that any manufacturing company succeeds with all these forces arrayed against it. If we leave the conceptual example and take a quick look at the complexity of a real-world wire manufacturing company and its supply chain, we can see that the issues start to become overwhelming. In this scenario, at the time, the manufacturer had an almost monopolistic supplier of copper rod, a commodity that was in the midst of a 3-year, 300% rise in price, a 7-day process time, and several end-market customers demanding deliveries via multiple channels within shipping windows of from 24 hours to 4 weeks, requiring a variety of fulfillment strategies from make to stock and make or engineer to order. Yes, achieving and sustaining world-class business performance is definitely a challenge for manufacturers.
Right, and so Scott, I guess a question that I had in terms of, getting my arms around this type of a complex process would be, in terms of that real-world experience, what was a manufacturer in this environment doing to try to get their arms around this type of a process?
Well, not to pat myself on the back here, but when I first got there, it was a very reactive environment characterized by a tremendous amount of firefighting. Delivery performance was abysmal. I think when I asked the question about delivery performance, it was kind of in the 30% on time or worse than that when they even measured it. It was amazing to me that was not a higher priority as far as improvement there. At the root cause of the issues was essentially was the use of cost accounting, typical in manufacturing, which used a variety of efficiency measures to drive decision making. Once the concepts we are presenting today were put into practice, the whole business became much more proactive and profitable. In fact, within a year, we were actually generating more profits than the company had in its existence of over 50 years. So, coming from a real-world situation where the term that we're going to be talking about today, throughput velocity, was put into play, it had an immediate impact on the company.
So, even something that looks that complex and is really suffering under those circumstances, there is, I guess, some hope to at least think about new ideas that might be able to really jumpstart some profitability, sounds like.
Yeah, I mean, it took a while. I mean, even the CFO was a little bit, wedded to the idea of machine efficiency and things like that. But, once he sort of understood, what this was all about, he became, my biggest fan and was a key supporter in, helping me create, things that would support the whole organization embracing this concept. And you could see here, not only is it complicated just because, it had 3 different plants. It had, material constraints. It had machine constraints. It has, in some cases, market constraints. I mean, this company had challenges all the way around. But once it got into a more proactive mode and understood who its target market was, it was pretty easy to really start to drive new initiatives for improved revenue and profit performance. All right. We have established that manufacturing is a complex endeavor that is, constantly being evaluated and measured by several stakeholders. At various levels within an organization, we have many traditional measures that appear to be aligned and in support of the corporate goals. Here's a few. At the end of the day, they say that what gets measured gets better. That's typically, something that you hear in a company that's embraced lean or is very big into Six Sigma, that kind of thing. I say, show me how someone is measured, paid, and I'll tell you what they do all day. Here is an example of an actual but very dysfunctional measure I encountered at a foundry operation several years ago. So what do you think happened at this plant when the end of the month was approaching and it was falling short of the measure? They would actually go out into the yard, select the finished product, remelt it, re-pour it, and re-inventory it. I mean, this kind of stuff still goes on today, and it's not because of any cruel intention any executive has. It's just that it becomes easy to sort of focus on efficiency as the driver of decision making. I'll give you one more example. If you could see on the stock price one here, the executive bonus, if $35 a share was achieved for 30 days. I don't know that that's necessarily a customer-focused measure, but that measure caused a company that I was working for at the time, their executives were doing everything they could to earn a $500 million bonus if they could get the stock price to $35 a share for over 30 days. I mean, that kind of stuff just totally wipes out the initiative of most employees and most companies. So it's really key to have metrics that are aligned with the market. I'm sure each of you knows how you earn your bonus, and that you spend most, if not all, of your time doing what you believe will earn you your bonus, maximizing at least one of the metrics on this slide, or maybe others that you have that aren't on this slide but are suspect nonetheless. We just hope that management knows what it is doing, and that the company will be successful if we stay focused and work hard on the measure. For now, we're going to focus on the measure of gross margin. You can see here we have an example of two products for which we currently take orders that have different contributions to our firm's profitability. Traditionally, most companies use gross margin as the driver of their business decisions. In the traditional cost accounting environment in which manufacturing overhead is allocated to products as the basis of cost, orders for product A, the most profitable in terms of gross margin in this example, would always be given priority over orders for product B. On this point, I think we're in agreement. This is logical and straightforward. How else would you go about it? Although a common approach, I'm not sure it is easy for most employees to know exactly how they truly impact the operational outcome. For example, what are the components of burden or overhead? How much of that can I influence? How much of it is arbitrary? Is it even legitimate for the product to be burdened with overhead costs? Before we can answer these good questions, let's acquire some new knowledge about a possible alternative way of looking at the world. If you'll indulge me for a minute, let's pause and define a few new terms that will become very important in our ability to challenge the conventional wisdom regarding profitability a little differently. In the prior slide, we evaluated the two orders on the basis of traditional profit and loss using gross margin. I would like to introduce three new measures which will serve as the foundation for others. The first measure is throughput, or T, the money a system generates through sales, not production. Very critical distinction here. Because T is generated as a result of a sales transaction, it has the financial characteristic of profit or loss and is not considered a unit of production, as is usually the case with the term throughput in manufacturing. The financial value of T for a given period is derived by subtracting the value of true variable cost for that period, including material and purchase price, from net sales. So the components of throughput are actual net sales dollars, meaning net of things like rebates, and true variable costs associated with the actual sale, things like commission and freight. Given the nature of T, or throughput, we would naturally want to increase this measure at all times. What is really good about T is that it is theoretically unlimited. Okay. The second measure is investment, or I, the money a system spends on items intended for sale or items intended for conversion into finished product, or inventory. The term investment is used because it includes capital which may also be sold. Given that the capital is held for a longer term, it is typical that the focus is on inventory when referring to I. Generally, from an efficiency or productivity point of view, the system tries to minimize its capital investment in the course of conducting its business. But if the theoretical minimum of zero investment were reached, the business would be non-existent from a practical standpoint. What is interesting to note is that there is a limit, 0. The third new measure is operating expense, or OE, the money a system spends to convert I into T. OE includes all expenses incurred by an operation, direct and indirect labor, as well as things like interest, lease payments, and taxes. Again, like the case with I, OE is a metric companies strive to minimize and which has a theoretical minimum value of 0. Essentially, the new measures of T, I, and OE can be used to classify all monies spent or generated by a manufacturing organization. Now that we've defined the foundational building blocks of our new measure system, T, I, and OE, we can express our organization's productivity by evaluating throughput in comparison to investment or capital productivity and OE, operating expense productivity. We can even use the new measures to express our traditional corporate measures if we wish, or my favorite measure, EVA. Remember this from the screen on the 2 guiding principles? So if you can notice here, if you can see my arrow, the T minus OE is really the net operating profit after tax number, translated, and the value creation, or the ability to earn the cost of capital, is defined by this equation. The net operating profit after tax, T minus OE, minus the investment we have times our weighted average cost of capital, which for today's purposes would be 7%. Now let's evaluate the same 2 orders vying for our limited and possibly oversold capacity, this time using the new measures as the basis for our planning and scheduling decisions. Let's consider the typical shop floor dynamic. Before we continue, I want to introduce a wrinkle, the existence of a capacity constraint. In this case, a work center in the middle of the routing that has 1,000 hours per month of availability. On a side note, if you see here this routing demonstrated by these 5 work centers showing different capacities in terms of hours per month, they also have below them the investment dollars associated with the resources in those work centers. It's interesting to note, I think, that even though the work center in the middle of the routing, which has the least capacity in terms of available hours, it's a $15 million capital investment to increase its capacity. If I were to actually spend the $15 million, recognizing that I have to then recover the cost of that capital, what would my capacity then be? I think you'll agree that it wouldn't necessarily be 2,000, because the system can only do 1,500 if we now move the constraint or the bottleneck upstream to the next resource in line. Just kind of keep that in mind, because the idea here is that we want to actually manage the constraint. We don't necessarily want to eliminate it. All right? So, both product A and product B require time on this capacity constraint, but product B requires 7/10 of an hour, whereas product A requires a full hour of processing time. Coincidentally, 2 of our best salespeople and notorious expediters booked large separate year-end orders, one for 1,000 units of product A and one for 1,400 units of product B. Each of these orders, if shipped complete before the end of the month, will ensure the plant achieves its monthly revenue goal, currently projecting a $5 million shortfall, so there's a lot of interest in these orders, and put the associated sales reps over their year-to-date revenue quotas. The question is, how would you allocate the capacity? These kinds of questions come up every day in the S&OP meetings. Because of the difference in processing time on the constraint, we can actually run 428 more units of product B than product A in the month. But why would we even think of committing our capacity to product B? Even though we could generate more than $1.5 million of incremental revenue than we could by producing product A, by doing so, we would lose $300 per unit here times the 1,428 units, or $428,400, for an opportunity cost of $628,000, which includes the $200,000 of profit lost by not making A. Hopefully you're able to follow this to this point. Let's take a closer look. If we look at the decision with the objective of maximizing throughput rather than gross profit, we see that the overhead costs are still present. But we should not penalize the product for potentially poor capital investment decisions by senior management. What we must focus on is the capacity of the constrained resource and how much bottleneck capacity is needed to produce the product. In this case, because product B can be processed by the work center in less time than product A, we have the opportunity to satisfy a demand of 428 more units of product B, enough to satisfy the full order, with an incremental true variable cost of $428,000 and an incremental revenue of over $2 million, or an incremental profit contribution of almost $1.3 million. Look at the combined impact of just 18 minutes of bottleneck time and the use of throughput rather than gross margin as the key measure. Even though advocates of lean accounting accept that overhead should not be allocated, only throughput accounting understands and accommodates the implication of a capacity constraint or a bottleneck. When thinking about this issue from a throughput perspective, it is the sales of product B that are the true engine of profit and value creation. In this example, the firm's assets should be utilized to fulfill the order for product B. Okay. Now,
Scott, this is Pete just jumping in here. I mean, for me,
yeah,
that was a really eye-opening scenario to walk through in terms of just thinking about, at a high level, which product should I make. It would have been obvious that it should have been product A rather than product B, but I think as you sort of uncover some of the layers of the detail there, you know, it's almost counterintuitive that when you start to factor in what really affects profitability, now you really start to expose some different kinds of thought processes, and I think we've touched on a few of those, including looking at the constraints that are in your process, you know. So this was a real eye-opener for me, and you know, if folks have questions about constraints and how you might prioritize these things and even go back to the foundational calculations, we can certainly do that later on as well. So thanks, Scott.
When you think about the capital equipment investments that are made by a lot of companies on the basis of price per part and efficiency, you know, it's just amazing to me that you know, this desire to, you know, this issue of trying to allocate or absorb the overall investment costs, you know, aren't having, you know, this kind of impact. So, you know, it's just unfair to the product, and certainly you're not going to be competitive in the marketplace if you're continually allocating costs that probably weren't even good decisions in the first place. Okay, so let's go one step further here. You know, taking it a step further, we just proved it is capacity-constrained resource time that is crucial, not total routing process time. The key measure to understand when loading the plant is throughput dollars per constraint time unit, or in this case, hours, or throughput velocity. And this is the essence of what we're talking about today. You know, notice that product A generates more throughput, the third item down, than product B, but not as much throughput per constraint time unit. Embracing this margin concept will have significant impact on future market, pricing, and production scheduling initiatives in your firm. After testing your firm's top 10 products with regard to their throughput contribution, take a look at the bottom 10. You will likely find a few surprises at both ends of the spectrum. You may find you are discounting products for which you have no capacity, or that you are trying to exact premiums for products that run on currently idle resources. I mean, I've been at this 25 years. I run into this situation, you know, so often it's just amazing to me that these kinds of things can still be governing how people, you know, make decisions within their business. I mean, you know, for the last 20 years, companies have been offshoring. Maybe some of you who are listening today have been offshoring operations, you know, under the perception that, you know, it costs less money to, you know, produce products, you know, offshore. You know, my position has always been, we got to get better. There's no way a company can outcompete with us in our own marketplace by, you know, sending materials over to China, having them processed, and then sending them back. I mean, there's just so many other trade-offs. And when you consider that labor as a percent of the sales price of a product is probably less than 10%. If the Chinese labor were free, it wouldn't have mattered. If we understood these concepts we're talking about today and could have put them to use in an effective manner. Now, given this information, it would be a very interesting exercise to look at the comparison of gross margin to throughput velocity for your firm's top products. In this real-world example, we see that a few products, looks like the 80-20 rules at play here, probably 20% of our products, designated here in this particular slide by these green circles, have both high levels of gross margin contribution and throughput contribution. But most products, you see them identified here by the red circles, or the 80%, exhibit high gross margin, actually provide relatively little throughput. If this is true of your products, it suggests that you have a significant opportunity for improved financial performance, and you should quickly start promoting and prioritizing high throughput velocity products. We promised that we would provide you with an idea you can follow up as your first initial step on the road to profit improvement. Here is a suggestion you can explore, maybe even this afternoon, I hope, as a way to move the dial. First, start by ranking your top gross margin products. Use column A of this chart. Maybe start with your top 10. Next, possibly with the help of your controller to break out the true variable cost, column C in this chart, take a look at their respective throughput contributions in column D. Then try to determine the throughput velocity, column F, of your top products. The information will be very useful, as we have seen, in making the capacity allocation call when capacity gets tight. We will be interested to hear what you find in your initial exploratory effort. If you would like help with clarification or interpretation, please give us a call. Once you have this data, if you would like us to work with you to develop throughput-based pricing or operation strategies, or help you build a business case to do so, just let us know, and you see Pete's contact information at the bottom of the chart there. With just this new understanding and perspective, we are confident that you can make a noticeable and significant impact on your business in as little as a single quarter. But you must take action. You will quickly find that you are more competitive than you thought, that you can leverage the tough economy to your distinct advantage, while your competitors use it as an excuse for paralysis. I work for a company that manufactures surgical kits, customized surgical kits, to basically help hospitals turn around their operating rooms, which is their profit centers, faster. And most hospitals of any size are doing 5 to 10 to maybe as high as 20,000 surgeries a year. They do probably 40 different surgeries. Well, we found that although we had 1,500 customers, only 155 bought more than one product from us. Of the other 1,000 customers that we had, they somehow or other only bought the one product that we made that we couldn't make money on. So it's kind of interesting when you start breaking this stuff down this way. You start seeing things that you don't really detect in the normal way of looking at the business. That's why if you start sort of looking at the numbers of products and customers, even work centers in this way, I think you're going to see some opportunity to make some very quick improvement in the overall organizational performance. Okay, so in a summary, we found out that the organization's imperatives are essentially to earn the cost of capital, and do this by maximizing throughput using throughput velocity as that key measure. We also learned that the conventional wisdom can be misleading. Gross margin is not equal to throughput. The new measures, I feel, are better aligned with the market. Efficiency or internally oriented metrics are not the same as effectiveness or market-driven measures. System throughput is governed by the constraint or the bottleneck. Today, most companies are finding that the bottleneck or the constraint is in the marketplace. They've lost a lot of business. So they had a big capital investment that was essentially sized to satisfy their traditional market. But some of that business has gone away. It's the companies that have now gone out and tried to replace that business with other businesses, not maybe so traditional, that are starting to find that they've now got some re-emerging capacity constraints inside the company. So the other thing we learned is that you can take action. You can take action today, and you can change the game. In today's global buyer's market, cost allocation is simply not an appropriate means of supporting effective decision making. Use the new measures, T, I, and OE, the logical advance of cost and lean accounting, as a way to more effectively sweat the assets of your firm and proactively drive for profits in excess of the cost of capital. What's more, armed with this insight, you are uniquely positioned to assist your firm to go to the next level of profitability and market share. Our opinion is that throughput growth initiatives should be aggressively pursued by any company committed to long-term growth and sustainable market leadership. Cost cutting, which most of us have been doing for the last 2 or 3 years, is just run its course. I mean, there's not much more you can cut. You're going to start cutting into the bone. It's time to start looking at growth initiatives that are driven by, performance measures or profit measures that are going to help us to stimulate the market and satisfy the market. Before I leave you, and before we go to questions, here's a question I have, and I think it's something that still holds true today, although I found this several years ago. The question is, what did you do back when interest rates were at their lowest in 80 years, crime was close to zero, great employees were looking for good jobs, technology made product development and marketing easier than ever, and there was almost no competition for good news about great ideas? And today, the throughput velocity idea is one of those great ideas. So stop thinking about how crazy the times are and start thinking about what the crazy times demand. There has never been a worse time for business as usual. Business as usual is sure to fail, sure to disappoint, sure to numb our dreams. That is why there has never been a better time for the new measures. Your competitors are too afraid to spend money on new productivity tools. Your bankers have no idea where they can safely invest. Your current and potential employees are desperately looking for something exciting, something they feel passionate about, something they can genuinely engage in and engage with. Now this quote came out of a Fast Company article from June of 2003. I mean, whoever would have thought that after the 2001, 2002 economic slowdown that we'd actually be in worse shape over the last 3 years. Well, even though it's just a matter of degree, the same facts are still at play here. Now, since then, since 2003, whoever would have thought that a consumer products company like Apple would have become the largest, most successful company in the world, especially when most economists today say that it's, that the recovery is not going to be a consumer-driven recovery. I'll tell you what, don't tell that to Apple. I mean, they've been able to figure out how to really satisfy their marketplace better than anyone else, and it's paid huge dividends. Anyway, I want to just thank you for the time you've taken today. I urge you to leave this meeting with the knowledge, confidence, and commitment to go make a difference. If you have any questions, we'd certainly like to take those up right now. If you don't have questions or are feeling comfortable at asking a question but would like to talk to us later, please feel free to follow up with us. We'd be more than happy to help you, gain a little bit more clarity on some of the topics we talked about today, or even figure out how you might want to take some first steps beyond what we talked about. So, Pete, I'd like to turn it over to you at this point if there's any questions that have arisen throughout the presentation.
Sounds great, Scott. Yeah, thanks so much. There are definitely a few questions that came up along the way, so we certainly expect that, and if questions are coming to mind now as we're entering our Q&A mode here, feel free to go ahead and type those into the question box or the chat box. Either will work, and don't be shy about your typing. That's okay, as long as I hopefully understand what you're asking. That would be a great way to go, and I definitely want to get into some details here. So, Scott, I don't know if you can remember, almost back to the beginning of the presentation, we had a question come in about the cost of capital. And the question basically revolves around the idea of, does cost of capital mean something different if you already own the capital?
Not really. I mean, you're depreciating the capital assets. At some point, you're going to have to replenish that capital. So, you do have a, I guess, when you start thinking about your business as a perpetual entity, You make a capital investment and then you do take depreciation. At some point in time, you're going to have to replace the assets. So you have to operate with the assumption that you still have that ongoing requirement to to recover that capital cost. I mean, if you're going to sell your business, you're going to the people who would be thinking about buying your business or acquiring you are going to take a look at it in the context of the discussion we just had today. I can go buy your capital assets, but I'm going to have to figure out a way to earn the cost I'm paying for those assets to generate a profit that makes it worth it. So cost of capital is, I'll admit, that it is a kind of controversial topic. You basically are looking at kind of a weighted average here. So you're looking at the borrowing rate, which for most companies today is 2-3%. But you're also looking at a risk premium, and potentially, if you're a publicly traded company, you're looking at a at an equity rate. So in times past, 10 years ago, and probably for the 20 or 30 or 40 years before that, the accepted sort of baseline for cost of capital was in the neighborhood of 12%. I can remember I was talking to a division of Raytheon at one time, and they hit me with this. They said, "Gee, we're trying to justify this acquisition, and we don't think that your return on investment number is right." And we were using a 12% number. And he said, I can go out and I can borrow money for 6%. And I said, well, you're part of Raytheon, right? And they said, yeah. I said, so what does the Raytheon CFO tell you your cost of capital is? He says 16%. So I said, well, there you go. I mean, there is an inherent risk of being in the manufacturing business. And that does require that you not only earn the borrowing rate, but you earn the borrowing rate plus an appropriate risk premium. So I've talked to the folks that have really made a living out of developing EVA programs for companies like Coca-Cola and Eli Lilly and Manitowoc and other companies of that ilk. And I asked them before, in preparation for this presentation, what should a company use as a cost of capital today? And basically they came down on the side of 7%. They also said, though, that when they do consulting for their clients, and they recommend a 7% cost of capital based on the tools they use, that a lot of their clients have actually ratcheted up their capital cost to somewhere closer to 8 or 9 or possibly even 10%. So, it's pretty common knowledge that there's an inherent requirement of management to earn the cost of capital, and I think to be safe, you should be looking at around a 7 to 8% number. I hope that's helpful in answering that question.
Thanks, Scott. Sounds good. We do have a couple other questions that came in as well, and these tend to center around some of those common terms that we talked about at the beginning. Certainly I myself expected terms like throughput and constraints to mean one thing, that throughput is just trying to produce more product. And I think we saw a little bit in the presentation that it's not just about producing more, but more about producing the profitable products and growing that as well. We also kind of touched on some areas where we mentioned, just looking at what we're measuring as being important and looking at efficiency and managing our constraints. These are, pretty common concepts that are out there. So what we talked about today in terms of how we calculate and measure things could be a little different from what people are used to. So, what if we go back to our management and say, we're really tied into measuring some of these things like efficiency and other key metrics. How could we potentially, is there a middle ground here to blend in some of these ideas with some more traditional ones?
Yeah, I mean, I guess what you run into, sadly, you're probably correct about the likelihood of executive resistance to some extent. I ran into it in a couple of places. Not because the executives don't want to succeed, but because it's a new and to some, a radical way of thinking about the business. So, I think to start, especially if you have any autonomy in your role in the company's business processes, the best way to convert the non-believers is to demonstrate your own ability to deliver your specific unit of process value or throughput to the next person in line in your process, your customer, consistently faster and more reliably than you have before. sooner or later your performance will be noted, inquired about, and once you have, the credibility, you can start to more aggressively advocate for broader adoption of your proven process. But this issue of metrics, I mean, if you went into each department in your company and started asking whoever was the head of that department, what their performance measure was, I'll bet you'd come up with, almost a different measure for every department. And that alone should suggest that there's probably some dysfunction as far as the overall performance of the company. But then if you tried to tie each one of those department measures into the overall corporate goal, I think you'd also see that there's some disconnect there. Salespeople are paid on revenue generally. They get paid commissions on revenue. Well, the company is really, trying to address the need of stakeholders by delivering net operating profit after tax. So, we got some dysfunction there. In a couple of the companies that I worked for as the VP of Sales and Marketing, we spent quite a bit of time making sure that every department and function in the company had measures that were consistent, using the T, the I, and the OE, and it was so simple for everybody to understand. So, once we had a little bit of a workshop on what those measures are, why they're important, and why essentially every other number you could possibly come up with falls into one of those buckets, it was a little easier. I mean, it's probably going to take a couple of times to kind of get the point across, but if you're in a situation where whatever they're currently using isn't delivering the goods, then I think you should have at least a willing audience in terms of looking for something that might help. I can tell you from practical experience, both in a medical device manufacturer and in an industrial wire manufacturer with completely different dynamics, this works. And what's really cool about it is you can actually go outside of your supply chain. You can evaluate customer value. You can work with suppliers. But if everybody is really on board with this idea that they're going to participate in the throughput contribution that's created, that spells mother as far as I'm concerned. And it really takes all of the mystery out of, how does a very complicated organization like a manufacturing company, make a profit doing something that appears to be quite simple. Buy, add value, ship. It just isn't that easy.
Right.
So I guess the answer to the question is there should be at least a yearning for something that's going to work a little bit better. And the simplicity of this is sort of a double-edged sword. It's simple enough for most people to understand, but it's so simple that guys that have been doing this for 30 or 40 years can't believe it's that simple. But I can tell you from practical experience, I've converted a couple of 40-year-old plant managers and operations managers and CFOs to this way of thinking, and it had tremendous results in both cases.
Right, yeah, and Scott, I agree. I think it's fair to say that, even for somebody who's been manufacturing for years and managing things very well, just getting an understanding of some of these new metrics and how they might apply, and then, working your way through a complex process like we saw with that wire manufacturing example, I think it definitely takes some steps there, and, we might not be able to touch on everything in a single webinar, but
Right.
We wanted to make sure that, of course, everybody who's here today will have access to the recording, and will definitely be available to follow up as we go along, too. It looks like we have time for maybe a couple more questions. I do have one that came in around the other common concept that we touched on today, this idea of constraints, and it had to do with, we've heard the term constraint in manufacturing quite a bit, mainly having to do with capacity there. What do we do if a manufacturer feels there may not just be a simple process like we talked about before where there's one clear capacity constraint right in the middle of the routing there? What should we be thinking about if we think we have multiple constraints to deal with?
Right. Yeah, I mean, most people feel that way because, the mix changes, quite a bit in most environments, and that has the effect of moving the capacity constraint. So although you may have several potential capacity constraints, theoretically you can only have one constraint at a time pacing the process. There are, some types of production flows, like a semiconductor, for example, that require reentrancy of material for the same order or orders into the same work center or machine, making that situation more complex than the average routing for most products. even still, this flow can be modeled and the constraint proactively managed. The key here is proactive. In most discrete manufacturing environments, it may be advisable to make incremental capital investments around the desired constraint. For example, you got a blast furnace. I mean, sometimes it takes a year or two to put, a new piece of specialized capital equipment in place. So, it's not something that you can just do on a dime. And so you might want to build, around the desire to minimize or eliminate the possibility of a wandering constraint. In high volume repetitive environments where the urge is to balance capacity, the situation may be more troublesome when mix changes start to become more frequent. It is likely, especially in a complex high mix production environment, that multiple capacity constraints do exist. In the case of the wire company I talked to you about, we actually had what we called 12 drums, depending on the mix that was coming at us. But we knew what they were, and we had them all modeled, and we were using a very proactive order commitment capability that allowed us to get in front of these issues. This is why a proactive planning and scheduling process must be put in place so the constraints can be identified and better managed rather than chased. This being said, it is also likely that the number of true constraints is much fewer than currently perceived. My suggestion is to start documenting the actual capacities of the suspect resources so that any decisions that must be made can be fact-based. I would also suggest that a move toward the goal of maximizing throughput over efficiencies will positively influence other contributing factors that limit capacity, such as setups and batch sizes. I think what you'll find, a lot of people, have batch sizes that are much larger than they really have to be, because of, again, an efficiency-oriented measure set. When you start only producing what you're actually selling, you're going to find that you're going to free up a lot of capacity. Typically, over the last 25 years, when we've, helped companies to sort of get a proactive handle on this issue, only committing the capacity that you actually have and the material that you can get before throwing out some kind of standard lead time, that goes a long way to making sure that you utilize your resources in the most productive way. So once you start really ratcheting back the batch sizes, only working on good product, only building what your order sizes are, or at least getting closer to that, you'll start to free up a lot of excess capacity. So my experience says that even though you may perceive that there's a lot of different bottleneck areas and that you're finding that you're chasing the bottleneck around the plant, that's not uncommon. But once you start doing this in a more proactive fashion and you start understanding that when I went to the wire company, we had 16-week lead times. As you saw, it only took, on an average, 7 days to make a product. So, ask yourself that question. How much of an issue is my ability to, to deliver and plan and schedule dependent on the fact that I'm actually quoting lead times that are just absolutely ridiculous? That actually creates, more contention for the resources. So, this can become a pretty complex discussion, but I think at the end of the day, it's really about identifying your target market, making sure you're devoting your resources to that target market that's willing to pay you a premium for what you're doing, whether it be a price leadership issue or a service leadership or a technology innovation value proposition. But once you know who your best customers are, then you want to devote as much of your capacity to those types of orders as possible. And in order to do that, you need to understand what's the throughput contribution. So, it's it's layers of onion, but it's relatively straightforward, emanating from the customer, and then back through the operation into the capital investments that you're making to satisfy that chosen target market.
Great. Yeah, thanks, Scott. And I think, there's kind of a progression here actually to some of these questions that are coming in terms of, first we need to get our arms around what are these new metrics that we're talking about, what's the constraint, how do I identify that? There's a bit of a quantitative analysis that needs to go on along here as we go along. And the last question that it looks like we have time for had to do with the idea of if we're able to understand some of these metrics and we think we've identified some of our bottlenecks or constraints, are there techniques that might help with planning and scheduling that could improve that throughput or that reduce that inventory investment or reduce some operating expenses? And I think I'll kind of jump in and sort of provide a short answer to that question. For everyone who's here today, of course, we are planning on following up with a series of webinars along these lines and exploring these in more detail. So certainly plans are in the works for a follow-up webinar that would dive into those constraint management and scheduling techniques. But in the few minutes we have left, I'll turn that over to Scott and allow him to answer that question.
Mm-hmm. Okay, well, thank you. Yeah, you know, over the last 20 years, I mean, there's been three dominant philosophies about how to run a company. You know, you've had lean, you know, with Toyota Production System. You had theory of constraints, which is a little bit different stripe of continuous improvement, and you've had the Six Sigma. Historically, these things have actually competed for the attention of people that were interested in improving their companies. My feeling is that it's a hybrid of this, depending on the specific nature of your company. I see lean as being sort of the umbrella strategy that talks about and focuses the organization on eliminating waste and improving process. I see theory of constraints as being the focusing tool. Where do I, try to eliminate waste? I mean, I've only got so many resources. I only have, so much ability, bandwidth to go after the problems in my company, and I want to go after the ones where I have the biggest bang for the buck. And then I would use the Six Sigma tools as the way to improve the quality and the processes that are driving the business. The metrics we talked about today are an integral part of the theory of constraints continuous improvement philosophy. Central to TOC is the idea of proactively managing the constraint or bottleneck to maximize system throughput. In the typical high-mix, low-volume, discrete production environment, regardless of product flow, the default schedule execution technique is what we refer to as drum, buffer, rope. Some of you may know what this is, and those of you that don't, it's a relatively straightforward execution strategy. But it's so simple in its conceptual essence that sometimes people just don't believe that it works. I can tell you, it works. That being said, depending on where a specific production operation sits on the continuum, whether it be high volume repetitive on one end or engineer to order on the other, and depending on the specific fulfillment needs of your target market customers, the range of scheduling techniques could include lean Kanban, drum buffer rope, or project management, or a combination of all of them. The key is to figure out how best to satisfy the demands of your chosen target market customers. As you saw in the wire example, we had all kinds of markets, and we had all kinds of distribution methods, and we had all kinds of fulfillment strategies. But you have to sort of understand kind of where your opportunities lie, and then you have to develop a delivery capability to satisfy those target markets in as profitable a means as possible. So I guess there's no single answer always, but you need to be thinking that it's probably going to be some combination of techniques that would get you where you want to go. And I don't mean to complicate this. I mean, I think it's a relatively straightforward thing. The assessment of how best to satisfy your target market can be done relatively quickly. But at the end of the day, these measures of TI and OE, I think, are fundamental to supporting the organization, no matter how, or no matter what markets it's going after. It's the best way to drive the organization's ability to generate profits in excess of the cost of capital.
Great. Well, thanks, Scott. I think we've neared the end of our time here, and just one final simple question that came in would be, can participants get a copy of the presentation? For sure, we will have the recording of the entire meeting will be sent out to participants, so you'll have the audio and visual that way. And Scott, I think that we'd be able to provide that copy of presentation to folks who would like that. If you'd like to go ahead and email me, I can go ahead and coordinate that with Scott. And definitely, again, feel free to contact myself or any of the other folks here at PlanetTogether. We'll be happy to connect you with Scott as appropriate. And definitely want to thank everyone, including especially our keynote speaker, Scott McMartin, for sharing his ideas and thoughts with us today. And we're looking forward to following up with you.
Yes, thank you, Pete. Thank you all for attending today.
Great. Well, thanks, everybody. This will conclude our meeting, and we're looking forward to our next sessions and future conversations. Have a great day.